Okay, good afternoon, everybody, and welcome to the ThinkLearning edition of How to Value a Stock. It is Wednesday, 9th of December. Welcome to people joining me live on this streaming webinar and to everybody joining me later on watching this video on demand. My name is Carl Capitalization. I'm the market analyst over here at Think Markets, and it is a pleasure to be with you today as we delve into practical applications of how to value a stock. A very broad range of things we could talk about, but I want to keep it practical. I want to keep it to things that you can actually start to do straight after this presentation. Before we get into the presentation, of course, we need to discuss the Think Markets difference, which is substantial. $8 flat rate trades, your own holder identification number. Very important. Make sure you ask your broker whether you have your own HIN. Unlimited phone support 24/5, and of course, no hidden fees, no subscription fees like many of our competitors have. Now, they are some fantastic reasons to get you to switch over to us, but at the moment, until December 31, that is, we have 10 free trades for you to use as well. And really, you can click on the terms and conditions on the website. Very few indeed. Open an account and get going. Pretty simple. And another great reason to switch to Think Markets. Okay, the agenda for today, obviously how to value a stock. We'll start off by talking about a fundamental analysis versus technical analysis. We're not going to decide or consider what might be better in today's presentation. That's beyond the scope of today's presentation. We're going to define each, and then we're going to focus on the first one. We'll talk about what is market value, what is intrinsic value, what is absolute value, what is relative value. And then, as I said earlier in the introduction, we'll look at some practical tools that you can start using straight away, and we'll finish off with some other practical considerations. Okay, what is fundamental analysis? It is the study of the intrinsic value of a company. We're ultimately trying to determine what the company is worth, and then we can use that value and compare it to what the market price of the stock is. Now, if our value or the value we consider the company to be worth is considerably less than the market price, it appears we've got something very cheap. If our expected value of the company is well above the market price, we've probably got something very, very expensive, and then you can make your trading decisions based upon that. What do fundamental analysts consider? Primarily financial performance. So we're looking at revenues versus expenses. That's your profit and loss. Your assets versus your liabilities. Now that impacts your balance sheet, your net equity, and your cash flow. So how much cash is passing through the business and ultimately therefore available to fund further investment into the business and potentially dividends back to shareholders. It's not just financial performance that fundamental analysts look at. They look at the management of the company, track record, how they've been handling crises. And there's a great example of some management teams doing very, very well throughout the recent crisis we've had with respect to the COVID-19 pandemic, and some haven't done so well. We'll look at the industry. Is it an industry that is on the up and up? I'm laughing because I know at the moment some of those medicinal cannabis stocks are surging at the moment, and certainly that's an industry that's getting some attention. Or is it an industry in decline? Potentially we saw as a result of COVID some bricks and mortar retail operations struggle while online businesses took off. We're also looking at the economy, so the local economy, for example, for us, the Australian economy, or the global economic picture. And we've seen very recently Treasury wine estates and other wine exporters in Australia being impacted by geopolitical factors. So we're also considering those. Basically, anything that could impact the financial performance of the company. And as it says there, ideally, we're trying to determine the value for the company to compare to the market price. Technical analysis, which is not the topic today, is the study of a company's share price. And we're looking, there's various techniques. I myself prefer to use price action. I use very few indicators. I use some indicators, but very few. And indicators, for example, moving averages, the MACD, and various other momentum indicators. They've all just flown from my mind at this point in time. Price action examples, candlesticks, peaks and troughs, things like that. Ultimately, what we're trying to do with technical analysis is forecast future price action. So we're looking for trends, uptrends, downtrends, sideways trends, and potential reversal points in the market. So fundamental analysis, more concerned about what the company is doing, how that's impacting on its earnings. Technical analysis is, I guess, at the end point, what is the share price doing and how might it change in the future. We're going to focus on the former, not the latter, and we'll talk about technical analysis a little bit later on in the presentation as well. Okay, let's talk about market value. Market value is the actual value of the company. It is the current market capitalization, which is simply the number of shares outstanding times the current share price. And whether you think the company is overvalued or undervalued, in some ways it doesn't matter. The market value is what the market believes the price of that security to be. And it fluctuates in real time. We know share prices, as long as the markets are open, are generally moving. So market value is often a moving target. The intrinsic value, that's a little bit more discretionary. So market value, that's what everybody else thinks. It's a bit of a reality. Intrinsic value is what you think the company is worth. You will determine that based upon your methodology. Within the methodology, you'll have to make some assumptions. So how good are things going to get or how bad might they get? And you'll have your own biases on what you believe is good value. And I'll just use a very simple tool here like the price to earnings ratio, which we'll talk about later on. Some people may think that a price to earnings ratio of 20 is cheap. Other people might think that's expensive. So this is a little bit more of a moving target here. The intrinsic value and beauty, as they say, is often in the eye of the beholder, but the ultimate goal is still the same as any fundamental analysis, and that is we are trying to compare our idea of what value is to the market value to generate investing ideas. Okay, absolute value versus relative value. And very simple concepts here. We won't spend too long on them, but absolute value is what we think the company is worth by itself. And do we think that's cheap or expensive based upon our view of value? We talked earlier about the potential of somebody using a PE ratio based yardstick for value. Is it cheap or expensive? Whereas relative value is how does the company's absolute value compare against other companies' absolute values? And this is probably a more useful tool because we start to determine what our optimal portfolio mix is. And obviously, we're trying to find the stocks that represent the best relative value. Obviously, absolute value is important, but often as money managers, we need to allocate the capital if we aren't happy with returns on cash and bonds. So the money needs to go in, and in some cases, you have to find the stocks with the best relative value and not necessarily just base your decisions on absolute value. In this case, we're often looking at the stocks which are showing the best relative value within a sector, within the broader market, for example, across the Australian Securities Exchange, and also potentially global as well if we are a global investor like many of the big fund managers are. Okay, in terms of fundamental analysis tools that we can use, I just wanted to put this one in because it is the one that professionals use. It's not the one we're going to be investigating today because in a half an hour webinar, there is no possible way I could comprehensively teach you to do a discounted cash flow analysis. You go to university and you spend a whole year learning how to do this. And I know for myself, because I did that, and there was some postgraduate studies as well that I've done to learn how to do discounted cash flows. So in half an hour, we don't have any chance of doing that. So I'm just going to mention it and say this is how the pros do it. And basically, we forecast every possible cash flow item that is in and out of the business over our investment horizon. Now, if our investment horizon is 5 minutes, we do it over 5 minutes. If our investment horizon is over 5 years, we do it over that time frame. And as you can imagine, thinking about every cash inflow and outflow for a company like BHP over 5 years is a substantial and onerous exercise. And then what we do once we forecasted those cash flows is we discount those cash flows back to a present value using what we call a discount rate, typically the risk-free rate, so it might be a long-term bond yield. And we compare that to the market price and once again determine whether we've got a bargain or not. Goldman Sachs, UBS, Macquarie, these are the types of research houses that will regularly have their analysts employ discounted cash flow analysis. And ultimately, it is this DCF analysis that drives market prices, make no mistake. Okay, if we can't do that, let's find some practical tools that we can all use right now and use them quite accurately and in a practical way to find where value lies in the market. And more specifically, where relative value lies in the market. So this needs to be about comparing a stock we're interested in against other stocks in the sector, in the market, and potentially even globally. Okay, we'll kick off with the price to earnings ratio. On the next slide, it'll say why it's one of the most commonly used ones. and for good reason. It's a really simple, easy, and effective tool for determining relative value. What is it? Well, as the name suggests, price to earnings ratio. So we're going to have a formula at some stage, and P is going to be on the top, and E is going to be on the bottom. P being price, E being the earnings of the company. When we talk about earnings of the company, we're typically thinking about how much money it earned for the last significant financial period, typically to the end of the financial year, and then we're looking at that on a per share basis, so earnings per share. We'll talk more about that in a second. But what are we trying to do? Well, if P's on the top, so if the price is bigger, so we've got a bigger price, now price is what we're paying for the company, then overall the PE ratio will go up. Okay, so that would indicate if you're paying more, you've got a higher PE. We don't really want a high PE. Okay, so if the price is low, we're paying very little for a set amount of earnings, then the PE ratio will have to go down. So it says here lower is generally better, but it is a ratio, so be careful. And I'll talk about that in a second. First, we'll talk about the fact that analysts often talk about this as the payback period. So if you've got a PE ratio, let's say you've got $1 earnings per share and the price at the moment is $10. Let's keep the numbers simple. And you've got a PE of 10. It would take you 10 periods of earning $1 per share to pay back what you've invested in the company. So we often consider this the payback period. And like any investment, you want that payback period to be as low as possible, and therefore you want the PE ratio to be as low as possible. Generally accepted measures of the PE ratio, we often think that 10 is cheap, or towards 10 is cheap. 15 is around about fair value. And as we get up to 20, it starts to be expensive. Over 20, I'll let you decide on how expensive things are going to get. We've got some case studies today, and we'll see stocks with varying PEs as well. I do put in here, and it's in a separate point because there's a question mark next to it, and that is often we see PEs that are really, really low, so under 10, 5, 6, 7. And either that stock is ridiculously cheap or it's potentially a sign of something wrong. Because in this PE equation, if the E goes down, or if the E is expected to go down, then we're going to have, we can have a really low PE today, but if this E, so if this E is expected to be 10 cents in the next period, okay, the PE is not really 10, the PE is 100. So this is next year's PE, and this is the current year's PE. Okay, so this already gives us a bit of an indication that we need to be able to forecast earnings and not necessarily look on current earnings. There are some stocks whose PEs look very cheap because their forecast earnings are going to be a lot worse than their current earnings. Okay, so pros and cons. As I said, most commonly used method. It's easy to use. It doesn't require us to determine the intrinsic value, so we don't need to do something as complicated as a DCF analysis to work that out. It's easy to calculate from information we can grab, and I'm about to grab the information from various websites for free to get that information. And it's easy to compare again, to use the PER to compare against a wide range of alternatives. So we can say that BHP, I'm using rough numbers here, I don't know exactly off the top of my head what they are. Let's say BHP's got a PE ratio of 10. And let's say that CPH, I think it's called, I mentioned medicinal cannabis stocks later. This might have a PE ratio of, say, 1 million. Let's put a number on it so you can compare based upon, the current earnings at least, which one's more prospective. Honestly, I don't know what the PE ratio of CPH is. I'm using it as a case study. Okay, so I've said here, look, it does not require a determination of intrinsic value, but what we're talked about here is the future. What is next year's earnings going to be? What is the year after that, year after that? What am I going to be getting for my dollar? So it doesn't require a determination of intrinsic value if you're, and you can use readily available information if you're happy to use historical PEs, okay? To get expected PEs, which is really what the market is moving on, is what the industry is moving on, you do have to be able to form some view of what the future earnings of the company is going to be. A couple of other cons for the P ratio is it's quite a narrow focus. I mean, you look at what's in the equation, we've got P and we've got E. So we've got earnings per share. It doesn't take into account, for example, debt levels of the company, if a company's taken on too much debt. And it can't be used on stocks without earnings. So if we don't have an E, we don't have a PE ratio. A company that has negative earnings or has made a loss, by definition, doesn't have a PE. Okay, let's have a look at the formula there. How do we work out the PE ratio? Well, we need to find out the earnings per share first, because it's actually the price divided by the earnings per share. And this is how we do it. We find the number of shares outstanding divided by the net profit after tax minus preferred dividends. Pretty hard to find stocks that have preferred dividends going around. So generally, it's the number of shares divided by the net profit after tax. And we get the PE ratio, which is price divided by EPS. Now, as I said, I'm going to give you a bunch of case studies on how do you actually do this a little bit later on. Let's get moving on these other practical tools that you can use. Okay, the next is the PEG. So it's the PE growth ratio. So how fast is the company growing its earnings? Yes, we know what the earnings are. We know whether it's cheap or expensive, but what could it be next year? What could it be the year after? And for that, we may choose to extrapolate out trends from the past. So what we can do very easily is find the earnings for the last few years. So this is all publicly available information. We can look for trends in that, much like we do in technical analysis. So if a company earned $1 million, then it earned 1.25, then it earned 1.5, and then it earned 1.75, it's not guaranteed, but there's a fairly good chance it's going to earn $2 million in the next year, all things being considered. And we can use these growth rates to get an idea of whether the price of the stock we're paying is incorporating some good growth as well. Okay, so it's the price to earnings growth ratio. Considers, I'll just finish off these points, considers the change in earnings over time. The market loves earnings growth, so prices tend to go up when earnings growth is very good. Once again, lower is better. Typically less than 1 is excellent, but we don't want negative because that would indicate we're not making money at the moment, we're making losses. How do we calculate it? And again, I'm going to calculate these for you a little bit later on. It's the PE ratio. We know already how to calculate that, divided by the earnings per share growth rate. I don't think I have in the slides how you get that, but that's pretty simple. Much like I described before, you're just checking literally what is the growth rate from this financial year compared to the last. So, for example, 1 million to 1.25 million, we've got a 25% growth rate. You literally just put 25.123, whatever it is, in the bottom of that equation. We'll see how to do that a little bit later on. Okay, enterprise value to revenue is the next tool we can use. Now, this one, because it's using revenue, it's not using profits. This is useful for valuing companies that don't have a profit yet. And there are many companies out there that are quite prospective because they're growing earnings rapidly and they're using the money that's coming into the business, that is the revenue, to reinvest back into the business to continue to grow profits, with a view that later on, once the business becomes more mature and that investment in growth is no longer required, at least to the same extent, some of that investment would be put into the bottom line. It becomes profits, and then it becomes potentially returns back to shareholders. And Afterpay is one we use as a case study today, which I think is a very good example of that. So it's a company we can use the enterprise value to revenue to calculate for Afterpay, and then compare against other companies to check that relative value. It takes into account balance sheet items like debt, assets, and cash. So it's a little bit broader than the PE ratio is. Once again, we want lower is better. And if you don't want to work out the enterprise value, because there's a little bit of work in that, you can simply use the market price to revenue as well, and you'll get a pretty similar comparison. But I do like using EV to R. It is the industry standard for this type of analysis, and it is also handy that it includes the debt level and the cash balances as well. Okay, enterprise value to revenue, how do we calculate it? So enterprise value first, it's the market capitalization of the stock. So literally, we've already discussed this, isn't it? So it's the number of shares outstanding times the price plus the debt. I'll show you how to find this, minus cash and cash equivalents, and then we divide that by the revenue. So obviously, the bigger the company's debt, the higher this number will be. Obviously, more debt's not always a good thing. Less debt would make it lower. Again, inverse for cash, more cash makes the number lower. So we're seeing reasons why a lower number is better. Market capitalization is how much you're paying. Again, you want the ratio to be as low as possible. I'll show you how to calculate in a second. This is the final one we'll look at for today. It's price to free cash flow. We often say that cash is king. Well, free cash flow, and that is the cash flow that comes from the day-to-day operating activities of the company. So it's not based upon financing activity. So cash that's come in from borrowings is not as valuable, certainly as cash that's coming in from regular day-to-day operating activities. And cash that comes from issuing shares, that's very different as well. So there's plenty of ways cash can come to the business, but we want it to be from that operating side of the business, the free cash flow. So if cash is king, well, free cash flow is whatever's better than the king. Once again, especially important for companies that don't have an NPAT yet, so we can have free cash flows but no profits. Once again, that cash flow is being used to reinvest back in the business through various expenses that mean we don't have a profit yet. Watch the cash balance, very important for smaller companies, because we can find that if companies don't have positive free cash flow, so there's we call it a cash burn, they are spending more than what's coming in the door, that will have a negative impact on their cash balance. If the cash balance gets too low and there's no money left in the bank, they can't operate the business, and they will tend to have to find funding opportunities. So they'll have to borrow more money from the bank, or they'll have to issue more shares, and often they issue shares at a discount. That's bad for the share price. And you can avoid getting caught by these fundraisings, these capital raisings, and many of us probably have bought that stock that looks like it's on a tear, then all of a sudden it's a trading halt and they've raised capital at half the price and the share price halves and we're very disappointed. We can do that by looking at this Appendix 4C, which again is publicly available information, and it comes out on a quarterly basis for many of those smaller companies. Okay, how do we calculate price to free cash flow? Pretty simple. It's a market capitalization divided by the free cash flow, and I'll show you where to get that information in a second. Nice little segue. This next slide, how do we find the information? Well, we need to find these things. The Appendix 4E, which is the full year report. The Appendix 4D, which is the half yearly report, probably less important. And potentially for those smaller companies, they do have to publish those Appendix 4Cs, and they are the quarterly cash flow reports. So I will go to the next slide, because we're going to consider 3 case studies here. The first one is Fortescue, the next one is Afterpay, and the final one is AVA Risk Group. And I'm calling Fortescue the cash cow. We've all been paying attention to the news recently and how well iron ore prices are doing and how much cash is coming into this business at the moment. Afterpay, as we'll see in a second, I call that the conundrum. How do you value a business that doesn't have any profits yet? And the final one is AVA Securities, which I call the mover, because it has recently moved into a position where it's starting to be cash flow positive after a period of being cash flow negative. It's starting to deliver profits as well, and actually has a fantastic growth rate in its earnings. Okay, back to where we get this information from. So, who would have thought? We're going to start at the ASX website. How boring is that? And the search button is just under my face. If you click there, or maybe that's not it, it's the login button. Okay, wait a second. Let me move myself. The search button is here. And let me move myself back. There we go. Okay. And we're going to search for the first company, which is FMG, or you can look up Fortescue if you wanted to type the whole thing in. Hopefully our internet connection works well for us today. And well, it's worth discussing this. If you haven't seen this before, it's the new ASX website. You get a price chart here that you can manipulate. I use my own technical analysis system. You've got various price information here. You might automatically think, well, hey, you've got the PE ratio straight away. That's the thing you want. Yes and no. I think this one's pretty accurate. But in researching this presentation and looking up some of the data, I have found much of this data, not some, but much of this data to be inaccurate. I can't explain why, and you'll have to talk to the ASX about why that's the case. As far as I'm concerned, as an analyst, I value accuracy, and therefore if I found one data point to be inaccurate, then as far as I'm concerned, they're all inaccurate. So we need to find a better way to get this information that we need. But we can already see some of these sort of industry standard measures here, like price to free cash flow. We've talked about that. Price to earnings ratio. We've talked about that one as well, and that's about it. Okay, what is interesting though, what is useful on this website are these little charts here. So we're getting this trend in earnings that we talked about before. This is potentially helping us forecast next year's EPS or understand what a growth rate to use in our PEG calculations. So we've got our revenue growth through here, and we've got our net income and net profit after tax growth through here. And for Fortescue, you can see a little bit of a dip in 18, but otherwise 18, 19, 20, and probably most likely to 21. We're going to see a really strong performance from this company, and you can literally grab the difference between those two, divide into that one, and you'll get a growth rate. Okay, and we're going to do that in a second. Trends are your friend here. You know I'm a technical analyst. You know I like trends, and I do like to see an uptrend in earnings when I do my fundamental analysis. The other important things here, we're going to go into the announcements in a second, but otherwise this little chart's quite interesting. It tells you what the PE ratio of the company is. So we know the PE ratio of Fortescue is about 10 compared to how much it's gone up over the last 12 months, I think, and it's gone up well over 100%. But then it shows you some of its competitors. So James Hardie has a very high PE, hasn't gone up as much. Rio Tinto has a higher PE, hasn't gone up as much, and you can maybe find stocks that you didn't realise were in that sector, go and investigate those a little bit further. The rest is much for muchness. Okay, we're going to go into see all on the announcements. It's going to take a little bit of a second to load up. And what are we searching for? I'm not sure if you remember. I do remember, but I just, for your benefit, I promise you I remember. I'm going to go back to here. Okay, so we're looking for the 4E. Fortescue doesn't have a 4C. So we will look for the 4Es. Let's go back. And you can scroll down and look through all of those. It would take too long. I prefer to go Control F, search just for 4E, and we get into the nuts and bolts of Fortescue's FY20 performance. And already you might be able to find things that you can use. I really wanted to do Fortescue because it's a very interesting case study as a cash cow. But then as I started to investigate, I realised that there's some interesting, even more interesting things which are worth using as a case study for, because all the prices are in US dollars, and you're going to find this from time to time. So I could have picked something that was in all Australian dollars, and that would have made my life easier. But let's do it the hard way. Let's use something in US dollars and show you how to deal with that. So typically how we start, we get a lot of overview items here, but we might find some things that we can use. So obviously revenue is one we need for our earnings value to revenue calculation. Dividends, we're not interested at this stage. I'm looking for earnings per share and to see if it's handy. It doesn't look to be handy, but we can get that stuff. Okay. Typically what you're going to find in one of these full year reports is you're going to find a lot of glossy pictures, smiling faces, generally younger than you are. Typically is the age group of what you're using, younger than me anyway, I should say. Andrew Forrest smiling back at us. Read this stuff. It's often very interesting. It gives you an idea of how they went, how they're feeling, what they're expecting, but not very useful in terms of us finding these ratios. So I'm going to, again, try and speed things up. I'm going to go statement of financial position, typically, is the quickest way to find it. Okay, so we used to call this the balance sheet. Certainly when I was at university, the statement of financial position was a balance sheet. I think it got called something else and now it's called this. But ultimately that's what it is. And if we go up, we get the consolidated income statement. If I just go up a little bit more, I'll show you that the title page, which is, oh God, it's not there. Okay. The title page generally says, financial statements, FY20 financial statements. Okay, but we've got the income statement. It used to be called the profit and loss statement back in the old days. And this is where we're going to find all the information we need. So let's kick off with the price to earnings ratio. Okay, price, that's pretty straightforward. Scroll up to the top of the ASX website and we get the price. It's not hard to find the market price of any stock you're looking at. Currently 21.66.5. And the other thing we can use here is the market capitalization, because we're going to use that quite often as well. Okay. So PE ratio, we've got the price. We need the earnings per share, and that's what I was looking for before, and it's going to be here. There it is there. So I like to use the diluted earnings per share, not the basic. Diluted accounts for any convertible notes that are sitting in the system. So a debt product that will eventually convert to shares, and that could be next week, it could be next year, it could be in the next 10 years, but I want to know if it happens, what my share of the pie is going to change to. So pretty simple stuff now. We've got 153. And we've got the market price. And don't forget, this is in US dollars, so we need to convert that back. Typically, I would quite literally just use the current $1 price, which is about 74 cents give and take. Okay, so I'll head back to the slide because the numbers are in there. Now, this is obviously based upon yesterday's price when I did this slide. And if we go for that 1.53 divided by, I must admit, yesterday's Australian dollar exchange rate, we get to 2.2425. That's the price, and you come out with 9.57 as a current PE for Fortescue. Now, if you wanted to go for a forward PE, you would extrapolate this potentially by the recent growth rate, or add or subtract any extra growth that you might think is going to be in the system. Now, it becomes changes from reality and historic to discretionary and future. And only the future will determine whether you're right or wrong. Once we have this 9.57, we can now work out our price to earnings growth ratio. And we would do that by putting 9.5% at the top and this 48.6%. Well, that's actually quite easy to get now, isn't it? Because if we go back to here, a couple of ways we can do it. We can either divide these two numbers, or we can go back to the ASX chart that we saw with those bars and the prices. And it's simply a matter of taking one from the other and dividing by into the previous to get a percentage. And that comes out as a growth rate of, and it's going to appear on the screen in a second, of 48.6%. And we simply divide that and we get a PEG of 0.196, which, when we remember what we thought was a good PEG, anything below 1 was considered excellent. So the price to earnings growth rate of Fortescue is fantastic at the moment. So it's got a very low PE. Remember, we said PEs of around 10 are considered to be very cheap, and it's growing earnings. So you've got a cheap PE with earnings growth. It's not one of those that has a cheap PE because the earnings are expected to plunge the next year. That's very important. Okay, enterprise value to revenue. Interesting, not as important for me for Fortescue because we know it makes profits. This starts to become more important for companies that don't make profits, and then we can compare against companies that do. Okay, in terms of how we work this out, if you remember, it's the market capitalization plus the total debt minus cash and cash equivalents. Where do we get that information from? Let's head back to the FY20 results for Fortescue, and we're going to go down to the balance sheet. And very easy now, we can just read off cash and cash equivalents. We can see that is 4,855. Of course, we need to convert that to Australian dollars. And total liabilities, somewhere down here, total, there it is, 10,154. And we're going to convert that back to Australian dollars as well. So we take those numbers, we plug them back into our formula. The market capitalization for Fortescue we got from the ASX website, don't forget. And with the revenues, where do we get that from? Well, that's back in our income statement. So that was 12,820, and we convert that back to Australian dollars, and we get our revenue number, which is this one here. So we found all of that information, and it was easy to find, and it gives us an EVR of 4.21. Now, is that good or bad? Hey, I don't know. I do know, but you have to compare it against other companies, and that's kind of the point. What we're working out here are absolute valuations. They're kind of useless unless we compare them to other stocks and get some relative valuations. The next one is the price to free cash flow. The price is simply market capitalization. We've already got that one. And the free cash flows, let's head back to the financial statements, and we're going to scroll down a couple of statements till we get to this one here, the consolidated statement of cash flows. And generally the first bit is the one we're interested in, and that is the net cash flow from operating activities. So you can see cash that comes in from customers, cash that goes to employees, cash that gets paid to just the general day-to-day expenses of the business, and also there's some interest in there as well. So 6,415, we're going to convert that back to Australian dollars. That is the free cash flow. Number one, it's positive. I think that's really important as well, that you find companies with positive cash flows, because that can be reinvested back into the business to grow earnings further or paid back to you as a shareholder. Often, if you just look at total cash flows, companies can juice those. They can issue debt. It looks like Fortescue is maybe paying down debt here. And they can issue shares as well. And on the first pass, you might say, oh, the cash flow is positive. That's irrelevant. You really want to know free cash flows and make sure that they are positive and growing as well. Okay, so we found that was the number converted back to Australian dollars, and we get a price to free cash flow of 7.64. Once again, we won't know if it's any good until we get to the next stock, which is we're going to use Afterpay. So let's go back to our ASX website. Let's find the search button, which is under my head, and let's go APT, click on Afterpay. We will note the last share price because we're going to use that, 97.85, and we'll note the market capitalization, 27.25, because we're going to use that as well. Same information here. I think this was the one I found that many inconsistencies in that data. Important to look at the trend. What a fantastic trend in revenues for this company. Astonishing, mind-boggling, and based upon all the information they've given us up till November, likely to continue. What we also note here is the fact that we can't get into the positive on our net profit after tax. Now, if they stopped investing in the business, we probably would get a profit. And Afterpay were very, very close to getting a profit this year, and they probably will do it next financial year. Okay, where do we get the information from? We need to go into our announcements. We click See All. And once again, we're going to go Control F. And remember, we're not searching for appendix anymore. We're just going to go for 4E. Hasn't appeared. We go Next. We go Enter. And there we go, the appendix 4E. So we click on that and we get our financial statements. Once again, we start off with some summary numbers. I'm looking here to see if there's anything I can use. Certainly I think that's revenue there. That looks like revenue to me, not net profit after tax, but we do need revenue as well. So there's one there. Pretty rarely do we find in the summaries everything we have to use. So how about we just keep going and get to the nitty-gritty? It's typically what I do. First thing I'll do is I'll just go Control F and find the statements, and then I'll come back and look at all the glossy pictures and the beautiful young people having a wonderful time with these products. So how do we do it? Do you remember? Does anybody remember? I'll throw it back to the crew. What are we searching for here to quickly get to where we want to in these financial statements? Statement of financial position. There we go. And what I wanted to show you on the Fortescue, if I scrolled up slide there, it wasn't on the Fortescue one, but it is often on the next one up. It says FY20 financial statements, and this is typically the section where I'll start. Again, beautiful young people using the product. Okay, Afterpay income. This is the one here we want, total income. So different ways they earn their money. This is from vendors, the businesses that they offer their products to. Then they have some services that they offer to those businesses, and then they have fees, late fees, charges as well, and that becomes the total income. So we need that one. What else do we need from here? Net profit after tax, this one here. You can work your way through all of these interesting little tidbits, but ultimately this is the one we want. The loss for a year, it's about half the loss from the previous year, and that's a bit of a track record for them, depending on how much they spend. At the end of the day, it's still substantial improvement. We won't go backwards and forwards here. We'll just get the numbers and cash equivalents. We need that. That's our balance sheet. We're going to use that in our enterprise value, along with total liabilities, which is here. And then coming into the statement of cash flows. And this is very interesting because we can see, unlike Fortescue, Afterpay is what we call cash flow negative. They've got a cash burn situation. There's more cash going out of the business from their operating activities than coming in. That's concerning for me, and that's probably the most concerning thing about Afterpay, full stop. They need to continue to add users to get that revenue line up to a point where they've got the critical mass that they're covering their day-to-day expenses. So they need to fund this cash burn by raising more capital from financing activities. So you can see, unlike Fortescue, who is paying down debt, these guys are taking on debt, and they're potentially also issuing shares as well, which actually they did not that long ago. We can see how much cash they've got left, 606. So this is on an annualized basis. At that rate, it's going to be less than 3 years for them to burn through all the cash they have unless they replenish that cash, and that is ultimately the big problem with cash burn. I'm pretty sure we've got all the information we need now, or at least we've pointed it out to do these calculations for Afterpay, which I've called the conundrum. How do you value something that has, we didn't find earnings per share. Look, keep scrolling, it's in there. But it's about negative 2 cents at the moment, so our PE is non-existent. Our PE growth ratio is non-existent as well for the same reason. What we can work out, however, is our EV to R, and that came in at 53.7. Now we're starting to understand on a relative basis what that 4.21 means for Fortescue. Remember what we said, lower is better. And price to cash flow, free cash flow, hey, we don't have any free cash flows. So we can't work that one out either. So a great case study, because it shows really the only thing we can work out right now on Afterpay is this enterprise value to revenue. And if we're going to compare Afterpay to other companies, that's the basis with which we have to do it. Good news is, on our next case study, I didn't want to show you that because it's going to give away. Oh, look, there it is there. It's there. What I'll do is, for, completeness, let's go back and click on that button and let's go AVA, which is a final case study. This is a small technology company. They do a lot of cybersecurity things and other applications in technology solutions for business, for industry as well. So they have little sensors on conveyor belts at Fortescue and BHP and Rio, and tell you how conveyor belts are going. Lots of other perimeter detection services, pipeline detection services as well. So if you've got an oil pipeline, is it performing the way it should do? It's a fascinating company. By the way, we've covered all of these stocks in our Think Technical section as buys. And you can see why I like AVA Risk Group. Look at the revenue performance. It's fantastic. It's almost, well, I would have to do percentages, but probably as good as Afterpay in percentages. But what I like to see here is we've got a little blip in the net profit after tax column into the positive. We can see that trend. If we did a line of best fit, little maybe not as good here, but line of best fit, we're definitely heading in the right direction there. So the trend is good. Let's go and we've got the price here, 76 cents, actually looking pretty good today for a breakout. So the chart looks good on this. And when we get the combination of the technicals and fundamentals, you can see I'm getting very excited. Market capitalization, also very interesting, a very, very small stock, isn't it, compared to the 27 billion odd for Afterpay and the, infinity billion that Fortescue is probably at now. Let's get our news. Where is that? Down here, see all. Actually, this is interesting because what I want to point out to you here, we can look for our 4C. So remember, don't search for appendix. Let's try and find the 4E. Well, it's not there. We go next. It's not there. Oh, I've done too many nexts. I might have, there it is. Okay, so we found the 4E. But what I want to show you here is also the 4C. There it is there. So we found one already. And what I want you to do, I'll set this as an exercise for you, is go find the last 4 quarterly updates. So the last 4 4Cs and track the free cash flow for this company. And you will see a trend in free cash flows going from negative to less negative to blipping into the positive. So we'll scroll down just for completeness. I'll show you where it is. Again, you can see I'm going past all the words to find the actual numbers. So free cash flows, 4 million and blipping into the positive there. This was to the end of June. And if I go back and find the most recent one, previous, and again, just search for it. It's the quickest way. That is the one for the end of September. And we'll go down, 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 down. So 2 positives, and if you go for the other ones, they're negatives but getting less negatives. It's unfortunate for me making my case on AVA, that one's a little bit less. But again, it's a lumpy, this is a little bit lumpy because it's a contract-based revenue stream. So when they get contracts and they have to fight for those and then they come in, they might get 2 or 3, then they might have to work on a few for a few months. So yeah, cash flows can be a little bit lumpy, but that's why we're looking for underlying trends. And we do have free cash flows there. What I won't do, just simply because we're way over on time, is go through the 4E for AVA. But you should have, with the 2 case studies we've done, plenty of practice of finding the information you would need to come up with these numbers here. Okay, so P, this has gone up a little bit today, hasn't it? So maybe you can tell me in the chat, what impact will the share price moving up to 76 have on the PE ratio? Will it send the PE ratio up or down? The earnings per share, which we've just pulled out of that appendix 4E, and we get a PE ratio of about 36. So, far higher than Fortescue, but at least it has one compared to Afterpay. Is it growing its earnings? Yes, it is. Yes, we've got the PE ratio in here, and its earnings growth rate is nearly 200% year on year, which gives it a PEG of 18.7. Now, that's better than Fortescue's. Yes, the PE is higher, but it is growing its earnings even faster than Fortescue. The enterprise value to revenue, 3.83. Now, that's also better than Fortescue's and streets ahead of the 53.07 on Afterpay, and the price to free cash flow is a bit higher than Fortescue, but at least we can work one out. And again, you're comparing this, compare it against other companies. Go and do this work and compare it against maybe just even the companies in your portfolio. Now, this is what I wanted. The slide where it has it all put together, and we can do some comparisons. Yes, AVA, look, Fortescue tick there, AVA tick there, AVA tick there, or they're close. I'm going to call that one a draw. Afterpay isn't winning anything, and that's a tick there. But it is, Fortescue is the cash cow now. You cannot doubt its credentials on that front. This is a conundrum for me. Really for me, this is more about technical analysis. This is where TA really comes to its fore, and we've consistently had a buy on Afterpay since $50-something, and we've been right, and it's mainly a technical analysis call on that one. We've had a Fortescue buy since 14 or 15. Now, that's a combination of fundamental and technical factors. We've only just recently put a buy on AVA Group around about 70 cents, and that one is a combination of fundamental and technical factors. Okay. We'll finish off this practical look. How do we use these things? Some investors have limits for their fundamental ratios. For example, some investors will only buy stocks that have a PE less than 15, and when that PE eventually rises above 30, they'll get out. So it's a system of getting in and getting out. And regardless of whether you pick fundamentals or technicals or PER or PEG or whatever it might be, it's good to have a set of rules that you can measure yourself by. And you can see, look, hey, I consistently did this over a long period of time and it worked. And how do I tweak things to make it better? Or I consistently did this over a long period of time and it didn't work. How can I tweak things and make it better? Now, if you don't have a system, for example, something as simple as that, how do you determine whether what you're doing is working or not working? Okay, so consistency breeds performance improvement, which breeds gains, wins. Okay, these PE ratios really, you can do historical ones and they're fantastic and it's better than nothing, but they're only really good at if you're really good at predicting the future. And then the future actually turns out the way you predicted. Question mark, come on. The EBIT, for example, in the PE ratio can and will change. It will change. So you've got to be able to roll with that and make adjustments to your models as you go along. So there's no perfect model. It's not perfect for Goldman Sachs, etc. Okay, and it's not going to be perfect for you. But find something that you're comfortable with. Careful, unless you're Goldman Sachs, you're using historical data. So maybe we need to make some assumptions about the future, and I've taught you how to do that in a sensible way, in a way that you can be consistent with. Markets do move on expectations, they don't move on historical data. Use the ASX website to get an idea of the trends in performance. Do you think it can continue? And that's really the question mark now. Now, this is where it's starting to get a little bit discretionary. Use fundamental analysis as a relative value tool, not an absolute value tool. There is value, even if you're using historical data, if it allows you to compare other companies. Use fundamental ratios to narrow the field of focus. If you can find a group of stocks that PEs have under 10, you can eliminate quickly 2,400 stocks out of the market and just look at 100 stocks potentially. So you're narrowing your field of focus. I find that works the best when you use it in conjunction with technical analysis. And I actually find it works the best the other way around. And that, I think, is a good little segue into the next slide, which is maybe that's the next approach. So what I like to do is run a technical scan to narrow the field. So we can go for, there's 2,600 stocks on the market. If I can use a technical scan to just find, say, the 30 stocks that look good on a technical case, I can then look at just the fundamentals of 30 stocks. And that's much easier to do than trying to look at the fundamentals of all the stocks. At the end of the day, you need to find the approach that suits you. Understand what your expertise level is. Hopefully, I've helped you a little bit with that. Do you have the inclination to do this research, and do you have the time to do the research? And maybe they're the two biggest factors. The good news is, hey, I'm here and I can do that research for you, and I do it every day of the week for Think Markets. You just need to go to our market news section of the website and read, or listen. I do these great video reviews where you can get all the research that I'm doing, both in terms of fundamentals and technicals, and that is a nice little plug for the market news section of the website. If you'd like, follow me. All the Think Markets handle is there on Twitter. Upcoming events on Monday, we have the weekly Think Tank coming up, and that is our review of the week that was and a look to the week ahead. And then that's it for for the Think Learning series for this year, but we will be back in January. And what a coincidence. The next one is going to be an introduction to technical analysis, and we'll get to see the other side of the coin there. And then we'll have an Ask the Experts session on the 20th of January where you can dial in and ask me about the stocks you're interested in, and I'll give you a fundamental as best I can and certainly a technical on those. The disclaimer before I leave you says that everything we've talked about today is general in nature. We are a regulated Australian broker. We do have products that could see you lose more than your deposit, so make sure you read this disclaimer carefully. Give us a call or consult the website for further details. It has been an absolute pleasure to be with you today. I hope you learned lots. All the best for your trading. Until we catch up again, bye-bye for now.